Afternoon, everyone. As followers of the Irish residential home building market, you'll all be aware that there's plenty of very well-regarded commentators on the Irish economy and indeed the Irish housing market. And I can see a number of familiar faces in that regard in the room today. So what we're not going to do is bore you with the minutiae of monthly trends here, but what we would like to do is highlight the key themes that we see in the market and that we believe are going to persist for a period of time, and then align how Glenveys is positioned against those key themes. Firstly, the Irish economy continues to outperform its peer group. 2020 is set to be another strong year in that regard, with over 5.5% growth forecast by a number of analysts. As you'd expect in an economy that's growing strongly, employment is increasing and wages are rising. In the context of a population with only approximately 5 million people, we've added 500,000 persons to the workforce since 2011. In addition to that, we're running in government budget surplus, and we're also seeing strong FDI. What gives us greater confidence as a business, however, is that almost all of the consumer indicators are in positive territory. We're seeing a continued expansion of real incomes. Retail sales remain robust, but at the same time, savings rates are exceptionally high. We're all aware consumer confidence did take a breath at the time of the Brexit debate, but that's now pointing in the right direction as well. At the same time as we're enjoying a very strong overall economy and consumer environment, we're also in the midst of a period of significant population growth. A country, with 5 million people, is expected to add close to 500,000 persons by 2030. It's that population growth that is the foundation of the housing need in Ireland and all of the stats you hear in relation to the number of deliveries required. A report published by the Central Bank of Ireland late last year puts that housing requirement at 34,000 for the foreseeable future. That assumes that the level of inward migration, which can at times be volatile, continues at its current pace today. But what it also assumes is that headship rates in Ireland remain static. Headship rates in Ireland are one of the highest in the EU. Ireland's headship rate declined rapidly as we went through the 1990s and early 2000s. But as soon as the financial crisis hit, at the same time as headship rates continued to decline in Europe, Ireland's actually increased. So what drove that increase? We didn't all suddenly decide that we wanted to put more people in the same number of houses. What you had was the outside of Dublin, that headship rate continued to decline in line with preferences and in line with what we're seeing on our sites, where the highest demanded product is the two-bed product. But within Dublin, due to the shortage of housing, particularly the younger cohort, stayed at home and are living at home longer, not out of preference, but because there simply isn't the accommodation there. Were Ireland's headship rate to converge with that of the EU, this would bring additional demand on housing above and beyond the central forecast of 34,000 per annum, and would in fact require 47,000 houses per annum. But the message we'd like you to leave you with in this regard is, we're confident that we can deliver the 3,000 units on any of the demand scenarios set out by the central bank because of the structure of the industry today. At our peak delivery of 3,000 units, we'll still be less than 10% of the market, given the base case output targets. What on the face of it would appear to be a very nurturing environment for the supply side. The supply side, as Stephen mentioned, continues to struggle to scale up. Unlike the UK, where when the financial crisis hit, balance sheets were resized, land banks got written down, but ultimately home building continued. In Ireland, the entire supply side went out. We continue to build one-off houses, and that's what you see in the numbers. But estate housing effectively dropped to zero. By the time green shoots arrived, equity returned to the market, there was a semblance of debt. The environment for home builders had moved on significantly. 2 to 3% cost of funds was replaced with 10 to 15% cost of funds. 100% loan to cost was replaced by 40% loan to cost. And compliance and regulation also moved on, and the sector was forced to professionalise, and that brought with it costs and a way of working which were unfamiliar. Again, as Stephen noted, the UK market has consolidated around the larger home builders. 80% of the builders producing less than 100 houses per year left the market in the UK between 1998 and 2015. We expect and we see the same happening in Ireland. It's not that there's a need for M&A. There are few scale players to acquire. It's that the structure of the market today makes it very difficult for that smaller home builder to build a sustainable business. As the chart demonstrates, there's very few home builders producing more than 200 units per annum. Ourselves and Cairn are two, and a number of others that continue to be supported by NAMA. One of the advantages that the macro-prudential rules have brought is that they've created a very sustainable and robust environment. As you can see from the charts, first-time buyer on the left, second and subsequent buyer on the right. New loans are hugging the limits outlined by the central bank. As a result, again as Stephen alluded to, the central bank believes the prices are 26% below where they ordinarily would be were the rules not in place. These rules are low by international standards, the UK operating at 4.5 times. Taking a medium-term outlook, our view is that given the clustering around the 3.5 times limit, that HPI is likely to at least equal wage inflation for the foreseeable future. And that's obviously absent an expansion of the likes of Help to Buy, which has been mooted by the government parties. Our experience of the mortgage market is that these LTI rules haven't tempered banks' lending appetite. They've just set the parameters for it. We're not only signing reserving units, we're closing them with the help of our banks. And we're building closer and closer relationships with these banks. The message we'd like you to take from this slide, and I know we've had new statistics out today which are positive, but we're clearly seeing on the ground, if we can continue to deliver product at less than 3.5 times income, there's ample finance available in the market. The extent to which there's the ability to pay beyond the 3.5 times limit is best demonstrated by the rental market. Here, the cost of renting is significantly above the cost of ownership in practically every market in the Greater Dublin area. This has contributed to the emergence not only of an urban PRS market, but a suburban one as well. The strong economy, underlying demand for housing, has attracted significant institutional interest to the sector. We are seeing yields tighten, and sellers of PRS product like Glenveys have actually benefited from the introduction of rent stabilisation measures. Our experience from our recent processes is that if you can create greater certainty around a rent, that tightens the yield, which is ultimately more valuable than rents racing ahead, which are harder to underwrite and therefore priced accordingly. It's also important that the product delivered is at sustainable rental levels, which again helps tighten the yield. Due to the lack of supply in the PRS market, transactions were initially focused on standing stock. Increasingly, investors are entering into forward commitments and forward funding arrangements, the shape of which Michael will take you through later in his presentation. What excites us, having run a number of processes, is the sheer volume of participants looking to get access to rental product in Dublin and the suburbs. Outside of the top 2 or 3 that you see in the bar chart, very few would argue that they're not in need of finding additional product to capitalise on the advantages of scale. 3.5 to 5,000 units is often mooted as the ideal number. One other point to note is that despite the continued requirement from occupiers and despite the investment of the institutions, the number of PRS properties in the market continues to decline. As Stephen noted, the mom and pop landlord is exiting. Why? Because of the onerous taxation environment, because of bank deleveraging, because of increased regulation. So we need more supply and we're getting left with less product despite this institutional investment. Putting all of that together, we believe that's why PRS is a market that's here to stay in Ireland. So what does that mean for Glenveys? We're operating in one of the best performing economies in the EU. The consumer environment is very healthy. Demographics and population growth are driving a housing need. This need is not being met by the supply side. Our approach to tackling these unique set of circumstances is threefold. We're delivering volume to the deepest segment of the market at prices that are financeable in the market. That's starter homes at less than $325,000. We're working with institutions to deliver quality product at sustainable rental levels. We also recognise that not everybody that needs a house can afford a house. That's why we're partnering with government, local authorities and other institutions with a view to delivering product on their lands to capture those outside of the affordability net. It's this three-pronged approach that we believe will ensure that Glenveigh is best placed to capitalise on the key themes that we see persisting in the market for the foreseeable future. I'd now like to welcome Wesley up to talk about our land investment. Thank you.